We looked at straight line method of depreciating a tangible, long-lived asset. We looked at the activity method. Now we're going to look at accelerated methods of depreciation. The idea here is that an asset may be more productive earlier in its life. And if it is helping us generate revenue better and at an increasing rate earlier in its life, it makes sense that we would allocate more of its cost on the front end of its life rather than the back end, or smooth it out evenly. So I'm going to go over two accelerated methods of depreciation. And the first one we'll look at is sum of the year's digits. What I have here is the sum of the year's digits multiplies the depreciable base by a fraction that decreases each year. So you can see mathematically how this would work. If we're decreasing that fraction each year, we will have a lower depreciation expense as time expires. Let's talk about this fraction. The fraction used in sum of the year's digits. The denominator. This is the sum of the years. The sum of the years for the estimated useful life. We'll look at that example in a second. Let's get these notes down. So the denominator is the sum of the years for the estimated useful life. The numerator is the years remaining at the beginning of whatever period or accounting year is under consideration. Let's look at an example from E-14. Same situation, but here we'll use some of the year's digits. It says that this machinery has a useful life of 10 years. If we're thinking about the denominator using some of the year's digit for depreciation, I have it on the screen here, 10 plus 9 plus 8 and so on is 55. That's going to be our denominator. Now, when we're thinking about year one depreciation, don't we start out with 10 years left in terms of the useful life when we first buy this, right? It's brand new. So our fraction for the first year of depreciation is 10 years of useful life left over the sum of the year's digits, which in this case is 55. If we're just looking at this as a fraction, this is 0.1818. Now let's think about year one. We purchased this in May, right? That's 8 out of 12 months. So year one depreciation would look like this. We have our fraction, we have the portion of the year, 8 out of 12 months, and we are depreciating the $300,000 of the $315,000 asset. If we think about this depreciable base, guys, once we depreciate it down, how much is going to be left on the balance sheet as book value? $15,000, right? And that makes sense because that's what we are estimating for salvage value. Capture that. All right, so when we do this math, this comes to $36,364 in depreciation expense for year one. Now let's think about this for year two. It gets tricky in this situation because not only are we dealing with this fraction that changes as time expires, but we are also have to consider that we've only depreciated 8 months up until this point, okay? So what we're going to do for year two is we're going to depreciate the remaining 4 months under this 10 years remaining, and then we will have 9 years remaining, and we'll take 8 months from that year in year two. So then we'll have a total of 12 months, 4 from the first 10 out of 55, and 8 from 9 out of 55. Let me put this on the board, it'll make more sense. Year two. First portion, it's going to be 4 out of 12 months. That was when we had 10 years multiplied by our depreciable base plus 8 out of 12 months beginning our second year of depreciation when we have 9 years out of 10 years left. So our fraction for some of the year's digits is going to be 9 out of 55. And we're going to multiply that by our depreciable base. Let's do some math. All right, when we do this math, the remaining 4 months from the first year depreciation is $18,181. And then the 8 months of year two, that would be May through December, relate to the second year of depreciation. Our fraction's 9 years over some of the year's digits, 55. Multiplied by the depreciable base, that comes to 32,000. So in total, for year two, we will depreciate this asset by $50,908. Let's go through the journal entries and then we'll determine book value at the end of year two. Year one, depreciation expense was $36,364. Accumulated depreciation, $36,364. For year two, we had depreciation expense of $50,908 and accumulated depreciation that year, $50,908. So in year 2, net income is going down by how much due to depreciation? $50,908. What is book value at the end of year 2? Well, we paid $315,000 for this asset, and over these 2 years, which is really 20 months, we had $36,314 in year 1, $50,908 in year 2. That's a total of $87,000 in accumulated depreciation. So our net book value at the end of year 2 should be $227,727. Double check that. There we go. We've got some rounding issues, but it's $227,778.